All righty. Today we're going to talk about a new realm of risk in DeFi. If you thought smart contract risks and hacking was a serious risk, you ain't seen nothing yet, because now there's a new realm of economic risk in DeFi. Let's talk about that. Welcome to the Crypto Bullseye Zone. My name is Kirk David Phillips, and I make common sense of the crypto space. So today I want to highlight an article that just came out on Coindesk. So let me share that. We'll get going. Okay, so this article came out on Coindesk, and this is a guest opinion piece by Jesus Rodriguez, who's the CEO of Into the Block. All right, so let's move on down here, and you can see where it says, the biggest risk in the current DeFi market is not based on mechanical failures or mechanistic failures, such as those caused by the collapse of Terra Luna, but rather on three key factors: scale, complexity, and interconnectivity. So furthermore, it goes on to say here that in simple terms, there are plenty of risk conditions in the current DeFi markets for which we don't have credible risk models. And that gap seems to be increasing, not shrinking. So that's the key thing here is, again, Benjamin Graham, godfather of value investing, mentor to Warren Buffett, said the essence of investment management is the management of the risks, not the management of returns. So risk is actually the single most important thing to focus on here. That's why this is important. So we're actually having a gap increase where we actually have less tools or tools that aren't quite as capable of giving us feedback value as to how to manage risk in DeFi. So that's going to be something we're going to need to continue to pay attention to. So let's move on to see what these actually the four biggest risks in DeFi are. So risk has been a part of the DeFi narrative since the beginning, and it's very easy to discuss in broad generic terms. All right, this new era of DeFi brings novel innovations and has grown significantly fast. So let's look at this example here where it says that, excuse me on that one. And to illustrate these factors, consider differences in quantifying risks for a basic AMM, which is an automated market maker model that has a few $100 million in total value locked. And that's versus one that uses restaked assets with the corresponding point system and introduces its own tokens and points. So it says that the former risk model can be solved with basic statistical or machine learning methods. The latter enters a domain of much more advanced branches of mathematics and economics, such as complexity or chaos theory, which are nowhere near being applied to DeFi. So that's the gap and what we need to be able to accurately or better manage and understand risk in DeFi. So here's the four elements of risk. Okay, scale, number one. So the principal relationship between risk and scale in DeFi is incredibly simple. So in the financial markets, modeling risk is at a smaller scale, say a few $100 million, is very different than managing and assessing risk at a few $100 billion. All right. So at a larger scale, there's always risk conditions that surface that were not present at smaller scale. So that's one of the big takeaways here. So you can manage things on a smaller scale. As soon as you have a lot more money at stake, it's a whole different ball game, and risk skyrockets. So let's move on down. Look at number two. Speed, the next condition of risk here, which says that the relationship between risk and speed is the traditional friction between growing too big, too fast. All right. As a risk condition, speed acts as an accelerator to scale. So we have a lot of speed in DeFi because what's happening is you have a lot of these protocols launched. This mentions EigenLayer, and there are many others that have this staggering multi-billion-dollar total value locks. It talks about months, but sometimes this actually happens in weeks. It's just mind-blowing, actually, to think about, because I don't think you could even have a legacy Fi comparison as to the amount of money that's flowed into some of these new protocols. So let's look at number three, which is complexity. Okay, so the entire field of complexity theory was born to study the systems that escape the laws of predictive models. So what that means is, thus far, predictive models have done the job of assessing risk, but now when you have a lot more complexity, now you have to move to a different theory to try to analyze it. So when you think about legacy fi, you think about banks, they're basically each bank is really just a different brand, but it's really the same thing. So all banks are essentially in silos. But when it comes to DeFi and the centralized finance, what we have is money Legos, modular finance. One protocol builds on another and then builds on another, and they're all actually interconnected like it's one giant finance application, if you will. So that's where the complexity comes from here. So it's another example in the new wave of DeFi protocols such as Pendle and Gearbox, which abstract sophisticated primitives such as yield derivatives and leverage. So that means you've got more and more advancements in the type of things that you can do with these protocols, and they are, so you've got the complexity here. And so actually, I think what I did here is I just actually combined complexity with interconnectivity. So you have the complexity where you can do all kinds of abstract things like it's talking about here, as well as derivatives. So those things are complexity, but still interconnectivity and complexity are related anyway, nonetheless. So widely interconnected systems can be a nightmare from a risk perspective because they can have cascading effects. So that means that if you have an impact on one protocol, depending upon the nature of the complexity and how deep the interconnectivity is, you could have something negative could actually ripple across the entire DeFi ecosystem. So moving on, let's go to this final thought here, which is transitioning from technical to economic risk. So I talked about how we know about smart contract hacks. So basically, decentralized finance is basically operates off of smart contracts. So you have programmable money, programmable finance. Now, if you have a bug, like all software has bugs, the question is how significant is the bug? If you have a bug that can be exploited, well, there's all kinds of articles that come out about all of the millions of dollars of exploits from these smart contract hacks. So we think of that as being a really big risk, which it still is. But now the economic risk here under this narrative is much, much to a higher degree because it's lurking and it's hidden. It's not like, even though that's the same as bugs in smart contracts, especially when smart contracts are audited. But nonetheless, this is a bigger risk and maybe a deeper lurking risk than the technical risk. So hacks and exploits have been a dominant theme in DeFi for the past few years, but that might start to change. The new generation of DeFi protocols is not only more innovative, but it's also more robust from a technical security standpoint. So even though the auditing firms have gotten smarter, meaning smart contract auditors, and protocols are taking security much more seriously, that means that risk is being mitigated to some degree. But now, as an evolving financial system, the risk in DeFi seems to be transitioning from technical to economic. The large scale, fast growth speed, increasing complexity, and deep interconnectivity are moving DeFi into an unforeseen territories from a risk perspective. Risk is your game. That's what it's all about if you're going to be successful in crypto. That's it for now. Please go below, like, and subscribe to this channel so we can keep bringing you more great content. That's it for today. Thank you.